Now, I want you to imagine, let me pull it up here. Okay. It is the 10th business day of the following month, right? I want you to imagine this. You just got your financials from your accountant. And this is what you get in your inbox, something that looks like this. This is an export from QuickBooks. Can you tell me in 10 seconds what actionable data you're getting from this? I can't even tell you, and I've seen hundreds of P&Ls. You're going to do a lot of hard work to dig into these details and get any kind of insight from this cluster of information. Okay, now I want to transfer over to a simplified version. Oh man, that's much better. Clean, simple. So this is actually a simplified, much cleaner version of the same exact financials we just looked at. I can actually see a picture of my business that's not overwhelming. Why is that so important? After doing these financial reviews, like I don't know how many I've done, maybe 1,000 at this point. The second confusion sets in for the business owner, you've lost the ability to take the useful nuggets of data, especially the business owners that have no accounting, finance background. The second you confuse them with data, they're just they don't understand. You need to simplify this, and you need to feed it to them in a very simplified format. And this is with anything, right? If I want to understand marketing, I want to understand it in a simplified format. So I want to give you a quick walkthrough of the way this is laid out so you can get an idea. So number one, we obviously start with total revenue. Right after that, we have our COGS, our costs of goods sold. So for example, if I'm a construction company, right, my COGS are my supplies and materials for the jobs, my subcontractor expenses, my equipment rental, anything directly attributable to producing that revenue right above it. That is what a cost of goods sold is. Okay. After revenue and cost of goods sold, I get what's called product margin. This is purely the revenue minus the direct COGS, no labor. We segregate labor right after that. So this is where your direct labor comes in. This is for employees that are actually producing revenue on the job site. For example, if it's a construction company, we've got some lawn care companies in here. We've got home service companies. Anyone actually going to the home producing revenue is your direct labor. Okay, then after COGS, after direct labor, I end up at gross margin. Let me emphasize gross margin because this gross margin is like always glossed over for some reason. Maybe it's because it's gross. I don't know. People don't like it. It is not gross. Gross margin is the core engine of your business. 9 times out of 10, if I see a business struggling, it's because of the gross margin. You're not pricing right. Your cost of goods sold is too high. Your direct labor is not as efficient as it should be. I'm telling you, gross margin is your core engine. If that is not right, nothing else is going to work. And 9 times out of 10, that is what is causing the issue with your profitability. Okay, so that's gross margin. We're going to circle back to that, but I just want to continue down here so you can see operating expenses. This is everything outside of your direct labor and outside of your cost of goods. So, for example, facilities, right? That's your rent, your utilities to maintain the day-to-day operations. You've got marketing and advertising. Your administrative labor. This is all of the labor that's not direct. So management salaries, right? Project managers, your assistant, your office clerk. This is administrative labor, not directly producing revenue. Payroll tax and benefits, and then another category. We're trying to keep this very simple. All the way at the bottom, you've got your net income. When you think of net income, I want you to visualize a net catching all of the profits as they trickle down from the top. That is your net income. If you notice, I'm not really covering revenue in depth because revenue is vanity and profit is sanity. I'd rather run a $500K a year business, keeping 20% of the profits, than a $2 million revenue business with razor thin margins. I will take the first option any day of the week because number one, I have less clients that I have to deal with, less headache and less moving parts, less staff. Like you guys know how difficult it is to manage staff. I mean, it takes a lot of effort because you're now in charge of these people. So I'd rather be a lean, mean business with less stress and massive margins, quality over quantity. And I'm not